Hello guys, in this video we will uh, look into the solvency ratios, which are also called the long-term debt paying ability ratios. These ratios are important for the major creditors, especially the banks when they have to either extend or issue the line of credit to the firms, and also very much important for the other creditors as well. For example, the long-term creditor who are interested to invest in the bonds of the company. So we will be covering under these ratios two ratios. One is the coverage ratio, the other one is the leverage ratio. The coverage ratio suggests that whether it is easy for a firm to service its debt, and the leverage ratio shows that how much dependent firm is on the debt to fund its assets and day-to-day operations. So again, the debt ratio or the long-term debt ratio and the solvency ratio is it comes under the bigger umbrella of the ratio analysis, and there are other ratios as well, like liquidity ratios, asset management ratios, profitability ratios, and the market valuation ratios. But in this video we will be specifically looking only on the long-term debt paying ability ratio or the solvency ratios. So when it comes to the long-term debt paying ability ratio, we need to understand the link that, first of all, why the firm raise debt. You might have heard many times because the companies try to borrow because this is actually a cheaper source of funding. So that is right, and one reason is that the interest paid on those the interest paid on those debt, they are tax deductible, and this is how they do the saving. But there is a concern of the business risk, and the business risk, the source of the business risk are the two risks, which one is the sales risk and the other one is the operating risk. So sales risk, when you are in a cyclical industry where there is a lot of seasonality business going on, there is a lot of risk of the sales as well. So sales can go up or sales can go down. Apart from that, there is industry competition, because if there is a competition, then the market share is divided among the main company and the other competitor companies, and that can reduce the sale of the company if there is a intense competition in the industry. Also, the technological changes. If for some reason tomorrow AMD comes up with a very better chip, then the sales of the Intel chips will go down. So if the technology is evolving very rapidly, that can pose a sales risk or sales threat, because the revenues can go down if because of a superior technology. The competitor of the firm will be able to sell more. Obviously, the sale of the company who is not keeping the pace with the technology, it will go down. So one reason for the business risk is the sales risk. The other one is the operating risk. So operating risk is attached with that how much operating leverage the company has. And operating leverage suggests that how much amount of the fixed cost is basically present in the company's cost structure. If the fixed cost is high, with the different level of the or volume of the sales, that fixed cost will remain constant. And if the sales volume will go down, then there will be the operating income or EBIT will be very much less. So this variation of the operating income or EBIT will be very, very high because of the larger fixed cost in the company's cost structure. So if the fixed cost is more, then the fluctuation in the sales can lead to a bigger fluctuation in the operating income or EBIT. So these two then are tied with the business risk, and the business risk is formally defined in the as the variability of the EBIT, which depends on the sales risk and the operating risk. Now, all the companies want to borrow more money because these are the cheaper funds available. So there is a low risk attached, obviously, and with the debt. And when there is a low risk attached, then obviously the creditor will be demanding less return. First of all, in case of the equities, the risk is high. So the provider or the equity holder, the shareholder, they need more return. So obviously, first of all, the cost is high from that link. Then on top of that, the interest, as I earlier mentioned, paid is tax deductible. That also reduces the cost of debt for the firm. So the firm business risk is the main determinant of its capital structure or level of borrowing. So if there is a high fluctuation in the operating income because of the larger fixed cost, and there is a high level of fluctuation in the sales, that will lead to obviously a higher business risk. And if there is a higher business risk, then there is a possibility that firm will not be able to service its debt, and so in other words, they will not be able to pay its interest. If that will happen, the bank can be declared bankrupt. So even though there is a desire to have more borrowing, but there could be a limit for that level of borrowing. And if the business risk is high, then it determines that the in the capital structure, the level of borrowing will be low. If the business risk is less, then yes, firm can afford to have more debt because they know that they will be able to service its debt and will not be declared bankrupt. So again, the firm prefer to borrow as it reduces the cost of capital, but they might expose themselves to a greater financial risk if they already have higher business risk. So again, you need to see that whether the company which you are analyzing, how much competition is there in their industry, technologically, how much changes or rapid changes are happening in the industry, and also is the firm is in the cyclical business. And all these three conditions are not mutually exclusive. There might be a firm where their technological changes in the industry where the technological changes is not rapid, but there can be say the business is cyclical. So you need to consider all these things while analyzing whatever company you are analyzing at this time or whenever you will be analyzing in the future. Now over here I want to show that how the borrowing can actually be beneficial when it comes to the cost for the firm. So let's suppose if there is a firm with no borrowing at all and its EBIT operating income is 100 million and the tax rate is 10%. So obviously if there is no borrowing, then there is zero interest rate and the tax is 10 million, 10% of 100 million, and the net income is 90 million. Now let's suppose if the same firm has borrowed 10 million and the interest rate on that 10 million is 4%. So the interest becomes 4% of 10 million borrowed amount. So the interest is 400,000. In this case, the EBT is 99.6 million and the tax is 9.96. In the previous scenario, it was 10 million. And how much is the interest rate? We know that it's 400,000. But if you see that tax has been reduced by 40,000, it's actually 0.04 million converted into a thousands, that will give you 40,000. So in other words, the government is saying that 10%, which is the tax rate, 10% of your interest, which is 4%. So 10% of 4% is whatever is the amount, which is 0.4%, we will basically fund. And the rest you will pay. So the after tax cost of debt will be 4%. into 1 minus 10%. So 4% into 10% is 0.4%. And if you subtract it with 4%, actually the cost is not 4% which the firm has to pay. They will be paying 3.6%. So first of all, the cost of the debt is low because it's less risky compared to the equity. The equity holders, they want more return because of the higher risk. On top of that, because of the nature of the interest is tax deductible. There is a further saving over there. So with the 10 million borrowing, the firm is not paying the 4% interest rate, which is mentioned on the paper. In fact, effectively, they are just paying 3.6%. So this is an important point why firm actually want to borrow. But again, if there is a high business risk, then there should be a limit to that borrowing. Because if the firm will not be able to service or pay service its debt or pay the interest charges, then they ultimately can become bankrupt. So this trade-off is there, and everyone needs to understand that why it is now important for the creditors or the lenders to basically look into the debt ratios of the firm to understand that how risky is the firm financial position. If they have more debt in their capital structure, it automatically means that they are becoming more riskier compared to the company who has less debt in their capital structure. Now, I'm analyzing Lululemon, which is the distributor, marketer, and the designer of the athletic clothes. And first point, which I'm doing is I'm trying to read the important section where they have mentioned about the long-term debt. That it is important. When you are doing the financial statement analysis, it's actually not only science, it's an art and science. So with the ratio analysis, you might have some formulas. You know that these formulas will give you some number. But just plugging in the numbers and getting the answer will not help you. It will give you the answer without any context. So you need to first of all understand the context, and Lululemon is a perfect example of that. And I will show you that why it's important to read and then use the ratios to basically make more meaningful interpretation. So I'm right now analyzing the fiscal year 2019 statement, which issued in September 2020. So after a year completed, those statements came out. And on page number 51 and page number 52, under the item number 8, there is note 8. So when under the item number 8, there are all the financial statement, and below that, in the last, there are usually the notes, which give you the detail and provides you the detail about different line items present on the different financial statement, like balance sheet, income statement, as well as cash flow statement. So over there, the note number 8 heading is long-term debt and the credit facilities. So that was very important. Before doing the debt ratio analysis or solvency ratios, I actually read these. And they are saying that the firm has no bond issued. So clearly there is no bond issues. Most of the financing is gathered from the shareholders. In fact, all of that financing is gathered from shareholders. But in order to run the day-to-day operations, there is a revolving line of credit of 400 million. And that 400 million is only in the North American market. So there is a 400 million credit line of credit available, and this is a revolving line of credit. So a firm, whenever they need to use it, they use it. And let's suppose if they used just for 5 days, they will settle the principal amount in 5 days, and whatever is the interest accrued on those 5 days, they will pay, and the debt is settled. But let's suppose, I think if I correctly recall, up till December 2020, 31st December 2023, If they they cannot pay, they can like simply up till that time, 31st December 2023, they simply cannot pay and they have to settle the debt by 31st December 2023. So if they want not to settle in few days but can extend that borrowing up till the 31st December 2023, they can do that. So 400 million is unsecured revolving credit is available. Within that 400 million, 50 million is available for the issuance of letter of credit. So the importer issue the letter of credit against which the exporter ship them the goods. So in many countries, they, or in fact over here as well, they actually act as an importer because most of their shipments are manufactured in Vietnam and all these Southeast Asian market, and the manufacturer of their clothes are sitting over there. They export their goods to the Lululemon over here in North American market, and in order to do that, they usually issue the line of credit, and the 15 million is available to issue the line of credit, which is the guarantee by the importer's bank. In case of this, we have Lululemon, which is the importer, that once if all the document like all the shipment is according to the terms and condition of the letter of credit, they will give the payment to the exporter on the settlement. So on the settlement date, whatever is the date. So 50 million is available over there. Then 50 millions are available under the swing line loans. In order to pay, swing line loan is the, or like for the individuals, we have the payday loans. For the firms, it is swing line loans. Sometimes in order to service the debt, they might have to borrow from the banks in order to service some existing debt. So within that 400 million, 50 million is available for the swing line loans, that if company has to settle some loan and they do not have a payment from these swing line loans, they can borrow and settle the loan only. So these are usually the high interest loans, like what happens in the payday loans for the individuals. So these are for the companies. The range of the interest rate based on the LIBOR. So the reference rate which they are using is LIBOR, London Interbank Offer Rate, plus some spread which they pay to their bank. But that range currently, when I'm analyzing these statements, is 1% to 1.5%. In the previous year, because the interest rates have relatively gone down, in the previous year it was, I think, 1% to 1.75%. So at least I know that where the interest rate for this credit is moving, and 1% is very manageable, interest rate. So this is giving me, just before analyzing my ratios, giving me some sense that like how well the firm is doing. Are they exposed to the interest rate risk or not? It seems like they are not that much exposed to the interest rate risk. Plus, there is a covenant. Covenant is actually the condition which should not be violated. If they will be violated, then in that case, the lender will have might come up with more stringent requirement for the companies. For example, one of the covenant is that their EBITDA, which is earning before interest, tax, depreciation, amortization, and rent for the leased premises for the store, their ratio to the interest charges plus rent should be greater than 2. So all the time from the EBITDA, each dollar of the interest rate and rent, it should have at least $2 coming from the EBITDA. So if it should be actually more than that, it should not go beyond 2. It should be actually is greater than equal to 2. So if it is less than 2, it means that the creditor is worried that company do not have much income available from the EBITDA, like from the operating income, plus because depreciation and amortization are the non-cash based expense. So it means that firm has that cash available, plus before paying the rent. So that rent if you divide them with the rent and the interest charges, the for every dollar paid for the interest which the company need to pay for the interest charges and rent, the company should have at least in or more than $2 available from the EBITDA. This is an important interpretation. If it is less, then it's a violation of the covenant. And I do not know what, because this is the private lending agreement between the company and the bank. So I do not know the detail, and they have not mentioned the detail, but there could be specific penalties there, which they need to pay, or might be there will be more stringent requirement. So usually some banks also increase the interest rate in that case as a penalty. That and in order to avoid that higher interest rate, company has more incentive to fulfill and do not violate these restrictions, which is in the technical term they are called covenants. So these covenants should not be violated. In the if you see on the 2nd February 2020, when the last 10K statement, annual statement was issued, the company out of that all 400 million have only 1.8 million outstanding under letter of credit. So they have issued the import LCs, letter of credit, against which the export has to be done, worth of 1.8 million. So like for a company like Lululemon, which is such a big company, this is nothing. So I can see, just even before going into the ratio analysis, I know that company does not seem to be in danger. It seems that they have a lot of flexibility when it comes to the borrowing. They can borrow more debt, and they can easily service that more debt if they will borrow. And in the Chinese market, they have a the same revolving letter credit facility available, worth of 130 million Chinese yuan. And this all, they are not even utilize 1 yuan out of that credit line. It's still available, but they have not utilized anything. So company seems, if I'll start looking at in the context, it seems like company is out of danger just reading that note 8 under the item number 8 of the Lululemon. Now, for many like students, this could not be the situation. Let's suppose if for many other companies which they are analyzing, usually these big companies like Walmart and other companies, they have a lot of borrowing. So we will also be considering some other companies' debt ratios or solvency ratios, just to see that how the usual companies does, because Lululemon seems to be very unique case where they do not have, they have not borrowed any funds, or they have not issued any bond, and like they are seems to be very much safe. Like usually such situation does not happen. There is certain level of borrowing for 90, like many companies, right? For majority of companies, that is relatively safe to say. Now, the first ratio under the heading of the leverage ratio. So again, the solvency ratio or the long-term debt ratios, they are divided into 2 ratios: leverage ratios and the coverage ratios. The leverage ratio tells you that how much company is dependent on the debt in order to finance its asset. So the debt ratio is simply the total debt divided by the total assets. So what percentage of the firm's total debt are financed with the total assets are financed with the debt. So this is one thing. But this ratio, as it seems very simple, it's not that simple. Many analysts use different versions of this. For example, few analysts simply subtract all the equities from the total assets, and thus they have only the total debt, both the current liabilities, total current liabilities plus the total long-term liabilities, and then they divide it with the asset. And this is, if I'll go with that version, I can see that Lululemon's total assets, 41% of the total assets are financed by creditors. Both they can be a long-term creditor and short-term creditor. And we know long-term creditors, they are not. So and in the previous year, the percentage was 31%. And if you go in the fiscal year 2017, when the statement issued in 2018 January, it was just 19%. So one reason why it increased because of a lot of lease obligations. So that lease obligations actually increased the numerator for the fiscal year 2019, and that because of this reason, the debt ratio increased by 41%. Now, some other analysts, they actually say that the day-to-day fundings, which it should not be a part of the debt ratio. It should not. It should be separate. So debt ratio is a part of the leverage ratio. It's just one of the ratio under the leverage ratio. There are other ratios as well. They say that these day-to-day operations, for which there is some credit available from, say, the accounts, from the suppliers under the head of accounts payable, they should not be considered. And only the interest-bearing long-term debt and the long-term obligation should be a part of it. And if I look into it, then only thing which I found is the sum total of the long-term liabilities for the Lululemon, and the total of the long-term liabilities is 708,718. And remember, all these numbers are in thousands. I'm ignoring the 3 zeros both in the numerator and denominator, both in the version 1 and version 2 of the debt ratio for the Lululemon. But all these numbers are in thousands. So this actually, because I already know the context that the firm is not subject to that much risk when it comes to the debt. I'm actually okay with the version 2 of the Lululemon. So if I'm the analyst, I will go with the version 2 rather version 1 of the debt ratio, and I will only include all the long-term obligations plus the interest-bearing long-term debt, and whatever is the portion of the long-term debt due within 1 year. So that due within 1 year will be actually coming from the current liabilities. So that heading of the current liabilities I will include. But because in case of Lululemon, there is no interest-bearing long-term debt, and obviously if there is no interest-bearing long-term debt, plus there is no liability obviously due within 1 year, so all I'm left is the sum of the or the total of the long-term debt. So whatever is the total long-term obligation, I'm including that in the numerator. So let me show you over here in the Excel sheet as well. So if you look over here, this total long-term liabilities I'm including in the version 2 of the Lululemon. So 708,718. Again, these numbers in thousands, but if I'm ignoring 3 zeros in the numerator and in 3 zeros in the denominator, I can simply write 708,718 divided by the total assets. Remember, the total assets is actually the sum of the total liabilities and total equities, which is the same thing over here. So I'm dividing the 708,718 by 3,281,354, and this is how in the second version I'm getting the debt ratio of the Lululemon. And this makes more sense to me, because if I'm a creditor, I'm like, especially the long-term creditor and a banker, I will see that how much company is subject to the interest-bearing loans, and the interest-bearing loans seems like it's not much, right? Now, over here, just let me take you back to the PowerPoint slide. The interpretation is simple, that for every dollar, not for every dollar, within each dollar of asset, 22 cents are financed by the creditors. So again, it's a very safe situation, and I have seen versus the competitor, the Lululemon is doing much safe. And with that qualitative data under the note 8, things are actually getting very clear to me. Lululemon is a unique case, as I told you. most of the firms have debt. So let's see what is happening with such a firm. And I have opted for the Walmart for that purpose. So for the Walmart, I have all these long-term debt, operating lease obligation, because these are the long-term obligations. And with the previous formula, if you remember, what was the formula? I think, just give me a second. Let me go back. Yes, the formula actually given on the top. Interest bearing long-term debt. So that interest bearing long-term debt is actually this one, long-term debt, 43.7 billion. These numbers are in millions. So I can say it's 43.7 billion, right? Or in other words, 43,714 millions. So this is this interest bearing long-term debt plus other long-term obligations. So operating lease obligation, finance lease obligation, capital lease and financing obligation, deferred income taxes, and others. All these are actually under the long-term liabilities. So I will include them over here. Plus, what I will do extra, which you cannot see over here in the numerator, I will also, from the current liabilities, I'll take this long-term debt due within 1 year, which is 5.4 billion. Right? So this is actually a part of this interest bearing long-term debt. So even though it's only one statement written over here, interest bearing long-term debt, but it includes both long-term debt due within 1 year plus the long-term debt from the long-term liabilities. This I'm getting long-term debt due within 1 year from current liabilities, and this long-term debt I'm getting from the long-term liabilities. And in the financial statements, in the balance sheet, exactly in the balance sheet of the Walmart. And I'm considering the fiscal year 2019 10K statement, and all these numbers I have gathered from the page number 52. The total assets is this. So once I added up all these numbers plus this number and divided it with the total assets, so it shows that for in $1 of asset, 35 cents are financed by the creditors, and the rest 65 cents, 100 minus 35, 65 cents are financed by the shareholders. So 35% of the company's total assets are financed by the creditors. Now, this is the second ratio under the heading of leverage ratio. Debt to equity ratio, and it's very simple. Simply take the total debt, divide it with the total equity, and if we'll see that, we can see that for every dollar of equity, the creditors has provided 68 cents to the Lululemon in the fiscal year 2000. Not in the fiscal year. It's actually, these statements are coming from the balance sheet, so it's a snapshot of the 2nd February 2020, and on the 3rd February 2019, 44 cents were provided by the creditors for every dollar invested by the shareholders. This ratio expresses actually the total debt as a multiple of the total equity. There is no version for this. You can simply use as a total debt, so that it can give you overall situation, that how much liabilities are there for each dollar which have been put by the shareholders. So again, in all these ratios, you need to see what is the industry ratio and try to remain close to that industry ratio. If that is not available for the same year, industry ratio for the same year, then use the average of the last 3 years data for the closest competitor. And for my competitor, I found that average of 0.96, and I used the Under Armour as the competitor for the Lululemon. Again, this number, lower the better. Also, in the previous case, for the debt ratios, lower number is better. It means if those numbers are low, then the creditors will be more confident about the firm's ability to borrow more funds and then service those debts or service the existing debt. The third is which many the buyers of the bond or the people who buy the bond and also the banks consider this information very important. It's actually the ratio of the long-term debt to the total capitalization. So the information, a financial information provider also give preference to this ratio. And the reason is that this gives you a clear picture that what is the situation when it comes to the most risky debt to fund the overall operations, like to fund the overall firm. And if you see over here, the long-term debt is actually the interest-bearing debt in the long term, plus whatever the portion of that debt due within 1 year. So that is actually your numerator divided by the long term debt, the same thing, plus the total equity. The denominator is called the total capitalization. When you add the long term debt and the total equity, this will give you the total capitalization, and it is specifically raised to finance the business over the long term. And the interest bearing debt, which is actually a part of the long term debt only, like this one, interest bearing debt, it is the riskiest debt. So that's why this gives a much clear picture, especially to those who wants to invest in the company through the debt for the long, like over a long term basis, and for the bankers. And for the Lululemon, we know it's zero because long-term debt is zero in case of Lululemon. So it's zero. And if you have zero in the numerator, you will end up getting zero. So everything over here, this one is zero. Over here, this one is zero. But you only have total equity. So you have zero. So that's why it's important to see that what is the case of the majority of the other firms which are carrying the long-term debt. So I went ahead with the Walmart data again from the fiscal year 2019. I found out that the long-term interest-bearing debt from the long-term liability is 43.7 billion, which in fact we already saw. And this is on page number 52 of 10K. The current portion of the long-term debt, which we all again saw on one of the previous slide, is 5.4 billion. And the total equity is 81.6. So it means that the 38% of the total capitalization. So for every dollar of the total capitalization, the 38 cents are financed by the long-term debt, interest-bearing long-term debt. Finally, we are moving to the coverage ratio. So under the leverage ratio, we have three main ratios. Debt ratio, and there are two versions of debt ratios. Then moving ahead, we had the debt to total debt to equity ratio. And then finally, in the previous one, we have seen that what is the ratio, like the debt to total capitalization ratio. So those three ratios are under leverage ratios. Now we have coverage ratios. Coverage ratio shows us that how easy it is for the firm to service its debts, to make the interest payments or any fixed charges, for example, lease payments or the preferred dividend payments or the principal payment. The most frequently used and the most important one is even it has a limitation, is time interest earned, which is EBIT, which is operating income, divided by the interest expense. So for example, if the EBIT, why I'm not giving the Lululemon example, they have some interest expense because of the revolving credit, but I do not find that this ratio very reliable for the Lululemon, and I'll show you on the Excel sheet later on. So if you have 100 million in EBIT, your interest expense is 0.4 million, which is 400,000. Then if you divide that, you'll get 250. So 100 million over there and divided by 0.4 million, you'll get 250. So for every dollar of interest which you need to pay, from the operating income, you have $250 available. Higher the better, right? In fact, this is a lot. The company seems very safe if this is the data, right? This ratio can be, it has actually limitations and it can be manipulated because it's an accounting number. So many people say that this ratio is actually the understatement of the ability of the firm to pay or service its interest payment. The reason is that depreciation and amortization, it is a non-cash cash based expense, and the firm has still cash available to service its interest payment or expenses. So some people try to convince that like they use, actually they add back the depreciation and amortization, the number that can come from the cash flow statement, and then try to calculate it. But mostly this ratio is calculated as it is, which is EBIT divided by the interest expense. So in other words, divide the operating income with the interest expense and you will have that number. And this is one of a very popular ratio and frequently reported, and it's actually a part of the loan covenant. So many creditors, when they grant loan, in the agreement they write that your this interest times interest earned ratio, say, can never be less than 6. Say, like, for every dollar of interest payment which you need to pay, you need to have at least $6 or more available under the operating income. So this is an important ratio. Now, for the Walmart, again, for the Lululemon, because there is not much interest needed to be paid because they do not have long-term debt, but they still have some, and I'll let you know about that number. But for the Walmart, it's more natural to see that what is happening when what is the times interest earned ratio, coverage ratio for the Walmart. The EBIT for the Walmart, again, I have taken these numbers from the fiscal year 2019 statement of the Walmart. EBIT is 20.6 billion. The interest expense is 2.6 billion. So if you simply divide that, you will get 7.92. So for every dollar which of the interest which Walmart need to pay, they have $7.92 available from the operating income. In case of the Lululemon, this second ratio under the heading of the coverage ratio is more relevant, and this ratio is called fixed coverage, fixed charge coverage ratio, and it do not only consider interest expenses, but they also consider all the other expenses. One of the major expense of the Lululemon is not actually the interest expense, which is only included in the times interest earned ratio. Under the fixed charge coverage ratio, lease expense is also very important, and lease expense is the major expense of the Lululemon because they have leased many stores for which they have to make the lease payments. So it is actually the EBITDA, means the limitation of the previous ratio is improved over here, even though the previous one is the more popular ratio. And this is EBITDA, so we add depreciation and amortization back to the operating income plus the lease expenses. We will add lease expenses, and then we see that how much once we add back the lease expenses we have available in order to pay four payments. One, the lease expense, the interest expense, the preferred dividends. Even the preferred dividend, the company can ignore to pay preferred dividend and they will not get bankrupt, but there is so grave consequences of this stock market consequences that companies actually try their level best to meet their preferred dividend payments and the principal payments of the interest bearing loan. So these four are the fixed charges which they have to pay. So they want to see that whether they have enough funds available to cover those payments. So in case of Lululemon, the EBITDA, EBIT first I calculated by adding the interest expense for the fiscal year 2019 back to the operating income, like EBT, which is earning before tax of the Lululemon for the fiscal year 2019. So for the income statement, from the income statement, I calculated EBT, which is 889,110. I added back the interest expense, which is actually $325,000. It's not million. So this shows that for the revolving credit which they have used throughout the year, they just incurred 325,000 interest. And once I added back these two, I can get actually EBIT, earning before interest and tax. Then the amortization and depreciation and amortization, they came from the cash flow statement for the fiscal year 2019. It is 161,933. And remember, I'm again ignoring all these three zeros, because once I'll take the ratios, these three zeros in the numerator and in the denominator are irrelevant anyways. They both will give the same ratio. Even if I'll start ignoring, I'll start putting up the three zeros in the numerator and the denominator, but it will create, it's like my slides will be more messy in that case. The lease expense is a big charge, and you can see that interest expense is just 325, and 256,682 is the lease expense for Lululemon, which is on page number 57, note number 13. This note 13 is, I think, the lease note, and this is under again item number 8. So within the item number 8, you have the notes in the last, and within the notes you have different note numbers. So note number 13. The tax rate is 28%. The preferred dividend is 0. The company has not issued any preferred stock, and the principal payment is 0 because the company has not issued any bonds, so there is no principal amount due for that. Why in the formula over here I have divided by 1 minus t? Just it's enough for you to know that because the dividend preferred dividend payments, you cannot deduct taxes on that. They are not tax deductible. So in order to do that adjustment, we have to divide the preferred dividend payment with 1 minus tax rate. Likewise, for the principal payment, we have to do it have to divide with 1 minus the tax rate. If you do not understand, no problem with that. It's enough that because these payments are not tax deductible, in order to do that adjustment in the denominator, when we have to write the preferred dividend and principal payments, we have to divide it with the 1 minus the tax rates. So in case of the Lululemon, once I'll add up all these things like EBT plus the interest rate plus the depreciation and amortization plus the lease expense, I'll get the numerator over here, and we have to divide it with lease expense, and I got 5.12. So in order to pay each dollar of the fixed charge, and the fixed charge we now know there are 4: lease expense, interest expense, preferred dividend payment, and principal payment of the interest bearing loan. The Lululemon has $5.12 available, right? Again, check the trend over the 3 years and also compare it with the competitor. And if you have an industry figure, that's actually the best, but if not, then use the competitor. And I found out that company is doing much better compared to its competitor, which is Lululemon. I'll also show you my Excel sheet over here, that why I have not calculated the interest times interest earned for the Lululemon, and why only I calculated the fixed charge coverage ratio of the Lululemon. Even though in Excel I did it, but I have not shown for the Lululemon that times interest earned ratio over here. And again, one reason you might have understood that why, it's because of the interest expense. It's just 325. Check the lease expense, 256,682. So way more lease expense compared to the interest expense. Main reason, they have not issued bond and they do not have to pay the interest on such long-term interest-bearing bonds, right? So first, let us finish the slides, and then there are many other important consideration. And where I was reading in the note number, I think 8, where about the credit facility in the item number 8. So there is note number 8 about the long-term debt within the item number 8. So you need to read, and most of these informations you will get from there. So these you have to pay some importance to these and do importance to these considerations. That unused borrowing capacity, how much unused borrowing capacity is there in under the existing loan agreement? I see that for the Lululemon, almost everything is like not utilized. Out of 400 million, just 1.8 million, that is too under the letter of credit. So once the shipment will arrive in, they will settle it down, so no risk over there. Check the covenants. They check that what are the covenants. For example, in order to pay the interest payment and the rent, the condition from under the loan agreement is that company need to have at least $2 available in the EBITDA, right? The operating income plus depreciation and amortization plus the rent which they need to pay. So they should have at least $2 or more than $2 available. So look for the covenants, because violation of the covenants could be very risky. So those covenant things were given in the 10K, again in the note number 8, and then I did the calculation and then found that company has enough dollars available, right? Like I can exactly not I calculated EBITDA, but I know for the fixed charges they are $5.12. This is what I have seen in the fixed coverage fixed charge coverage ratio. And also see that is there any balloon payment coming due in the near future. Normally they give you in that like long term liabilities the schedule that how much payment is coming due in 2020, 2021, 2022 under the notes. So check that is there any such payment is available. I have given you the page number on the slide, so you can go back and check my numbers from the slides and compare it with the 10K of the Lululemon, and I also given the page numbers as well. Again, this is the fiscal year 2019 statement which was issued in 2020 10K, right? So if it is fiscal year 2019, it is not issued in 2019, but once the fiscal year 2019 ended, then in 2020 these 10K statements were issued. And also see that whether the company is exposed to the fluctuating interest rate. If there is a fluctuating interest rate, then there is a more risk available. And if we'll see the summary, we have covered the long-term debt paying ability ratios or the solvency ratio. Under these, we have two groups of ratios. One is leverage ratios and coverage ratios. Within the leverage ratios, we have three ratios. Within the coverage ratios, we have two ratios. Let me show you my Excel very quickly, and then we will conclude the lecture. So these are my ratio analysis for the Lululemon. Over here, whatever I was showing you over there, I did the debt ratio version 1, debt ratio is version 2. Over here, I used the total debt. So both sum of the current liabilities plus sum of the long-term liabilities and divided by the total assets. And then over here, the interest-bearing loans and the other long-term debt plus in this remember this interest bearing long-term debt, also the 1 year interest payment due within the within 1 year, whatever is the interest payment due for the long-term debt, the number will come from the current liabilities, right? I have taken in the version 2 and I have calculated these two, right? In case of Lululemon, there is no interest bearing loan, so I simply actually took one number from E35. If you go into the E35, what I do have over here, only the long-term liabilities, which will include all the long-term obligations. So this is what I am doing over here, right? But in case of Walmart, if you go back to my third or fourth slide, you might have seen that over there I've added all the long-term liabilities and also used the long-term debt due within 1 year, which will come from the current liabilities, and I'll ignore the other current liabilities because those are the liabilities for the day-to-day operations. I'm more looking towards that what will happen in the long term, right? Then the debt to equity ratio, like for this you simply have to use the total debt and divide it with the total equity. Then also the long term debt to total capitalization, we know that it is 0.00 for the Lululemon. They have not issued any bond. Then times interest earned. Why I am not considering the time interest earned for the Lululemon? I am not sure of you over this over the statement. No, sorry, over the slides. Check over here how many different numbers they have. Right, like in on 2nd February 2020, right? This is uh, yeah. So interest paid expense that I got the interest paid expenses, and and if you see it was 325,000, which I also showed you on the slide. But these, look at the inconsistency of these numbers: 2762 and versus 514 versus 57,500. So in fact, this shows that the nature of the borrowing of Lululemon is like, these number is actually very much like in line with the nature of the borrowing of the Lululemon, and they are basically borrowing through the credit line. Whenever they have, like, they feel like, they simply pay, settle that resolving credit, and or it is not like a bond where they keep the payment of or the like the financing or the debt for a very long period of time and keep on paying the periodic interest payment. Here there is no periodic interest payment. Sometimes they might have settled after 2 days, sometime after 30 days, sometime 25 days. We do not have that data available. The only companies know that. This is sort of a private data they have, and under the accounting rules, it is not necessary to mention all that schedule under the 10K. But I do not trust this interest times interest earned ratio for the Lululemon. So I'm more into this fixed charge coverage ratio, and where I'm actually seeing that through the EBITDA plus the lease expense, how much they have available in order to pay their lease payments. So it's more reliable. There is a consistency in that ratio. And this is all. We are going to conclude the lecture over here. And last thing, if you see over here in the numerator, some number are coming from the cash flow. So this cash flow number is the depreciation and amortization. The 325 was the charges for the interest expense, and this is the lease expense charges, and I divided it with the sum of the lease expense plus the interest expense. Again, interest expense is very low, and it shows the nature of the borrowing of the Lululemon. There is no preferred dividend and no principal payment for the long-term debt. That is why we have only two numbers, sum of the two numbers in the denominator. That's all, guys. So just look into your firms and try to find out these ratios. And if you have any question, you can email me or you can write down the comments. Thank you.